Welcome to another episode where our goal is to turn market mayhem into money wisdom. So unless you've been living under a financially sound rock, you've probably noticed the markets doing their best impression of a roller coaster lately. So why is that? Well, President Trump just dropped what I call the tariff triple threat. New taxes on goods from Canada, Mexico, and China. So the market's reaction? About what you'd expect when you tell three of your biggest trading partners they're going to pay more at the door. So major markets are having a bit of a stomachache. So investors are nervous for two main reasons. First, these tariffs could make everything from your morning avocado toast to your new iPhone cost more, as if inflation wasn't already noticeable. And two, economic growth might pump the brakes just when we thought we were starting to cruise down easy street. But before you consider converting your 401k into a mattress stuffing fund, let's take a deep breath together. So here's the reality check we all need. We've seen this tariff tango before. And while these trade tensions absolutely can and do cause short-term market drama, history tells us something important. The actual economic impact often turns out to be less scary than those initial "the sky is falling" market reactions. So think of it like this. Markets react to tariff news like I react to finding a spider in my bathroom. Initial panic sometimes exceeds the actual threat. So over the next few minutes, I'm going to walk you through what's really happening in the markets, what it means to your portfolio, and just why maintaining perspective during these volatile periods isn't just good for your financial health, it's essential for your mental health too. Now let's talk about why investors are nervous. The US has what I like to call a shopaholic problem with our major trading partners. We buy way more from them than they buy from us. So let's take a look at the chart. This chart shows our trade deficits, which basically is a fancy way of saying America's international shopping tab. These numbers represent how much we're importing versus exporting. So those are crazy numbers. And here's where it gets interesting. When we impose tariffs, these countries tend to retaliate by slapping their own tariffs on our exports. And since they're already buying less from us than we buy from them, you can see why Wall Street gets nervous. But before we all start stress eating our emergency chocolate supplies, remember I said in my last slide, this isn't our first tariff rodeo. During the previous Trump administration, these tariffs weren't just random economic fireworks. They were negotiation tactics that actually led to new trade deals with Mexico and China. There was method to the madness, so to speak. The market might be having a bit of a tantrum right now, but history suggests we should avoid overreacting. So what's the best case scenario, you ask? Either these tariffs are short-lived, or they motivate our trading partners to come to the negotiating table. But here's my favorite part. During the 2017 to 2019 tariff palooza, markets had similar panic attacks when tariffs were announced. But how did investments actually perform over that period? Surprisingly well. The bark was worse than the bite. The lesson here isn't to ignore trade tensions because they do matter. As smart as investors, we need to separate the headline hysteria from the actual economic impact. Sometimes the market reaction is more dramatic than the final economic episode. Let's talk about something that gets way too little airtime in financial media. Market pullbacks are as normal as my son and daughter arguing over the remote control. They happen. A lot. This current tariff tantrum has pushed the S&P 500 down about 5%. And that sounds scary until you realize we've already weathered two similar drops in 2024 alone. And we saw three of these in 2023. And if you were invested during the 2022 bear market, congratulations on surviving a dozen of these pullbacks. So here's what the doom-scrolling headlines aren't telling you. The economic fundamentals still are pretty solid. Corporate earnings are growing, so companies are making money. Unemployment is hanging out at a low 4%, so people have jobs. Wages are rising, so people have money. And productivity is steady, so work is getting done. And here's my favorite reality check, the credit markets. While stock markets are having their moment, The bond market, which is like that wise elder sibling of financial markets, is staying remarkably chill. High yield spreads remain below pre pandemic levels, which basically means the smart money isn't panicking. So, what's the translation? Bond investors, who are notoriously cautious, still believe in our economic growth prospects. Look, I'm not saying tariffs are economic vitamins. I mean, they can absolutely slow growth and nudge inflation up, but history has taught us something valuable. Both markets and the economy have shown impressive resilience even during trade tensions. So think of market pullbacks like those fitness challenges your friends keep posting about. They're uncomfortable while you're going through them, but they rarely change the long term trajectory. So, what's the takeaway? Stay invested, stay diversified, and maybe stay away from checking your portfolio value every 15 minutes. And if you have questions about tariffs or the markets, or just need someone to talk you off the financial ledge, that's literally why I'm here. Reach out anytime. Helping you navigate these choppy markets is what gets me out of bed in the morning. That and my wife pushing me off the bed because I snore. But thanks for watching. And remember, successful investing isn't about avoiding storms, it's about learning to dance in the rain.